Welcome to Making Money. This is Matt McCall. Thanks for joining me. Coming to you from a special location today from the annual Stansberry Research Conference up here in Boston. Having a great time, several hundred subscribers, new subscribers here, all getting together, some of our best analysts. I'm going to talk to you about some of the speakers that we had today and what I saw. All that and more coming up right now on Making Money. Once again, welcome to Making Money. This is Matt McCall. As I mentioned, it is the 25th of October this week. And boy, oh boy, it's the favorite time of year. Outside of Christmas and the World Series with the Phillies in it this year, this is my third favorite time of the year. We get together for nearly a week with our best subscribers here at Stansberry Research. Get to meet old friends, get to meet new people. It is really, honestly, just a meeting of the minds where we get to sit down, talk things we care about. It's our passion, talking shop. And of course, sharing everything and educating all of our subscribers along the way. And what we do, folks, we bring a lot of great speakers. So if you're not here this year, you better get your butts next year to the conference. And next year, we're back at the Wynn Encore in Las Vegas. Tickets are on sale now. We'll tell you more about that in a minute. But let's talk about what we saw here today. We kicked off the show with Scott Galloway. If you're not familiar with him, he's a professor, NYU Stern Business School, and had dinner with him last night as well, so I got to meet him for a little bit, first time meeting him. Followed him for a long time. We can't be any more different, honestly. I am quite the optimist. I've had 4 people come up to me today, this morning alone, say, we're so happy you're an optimist because there's a lot of negativity in the world right now. And not that Scott's a bad guy by any means. He's a really smart guy, very successful guy, and a really nice guy. But he tends to be a bit of a pessimist. And he said in his speech today, there's a lot of people out there making the next generation of vehicles, whether it be EVs and our autonomous vehicles, but somebody has to make the seatbelts. He's the guy, the pessimist, who says, whoa, hold on, that sounds great. What about the seatbelts? And I thought he put that a really great way. But his presentation wasn't all negative. He talked about a lot of his predictions from 2022. Fortunately, some of the really bearish ones did not come true. I will say this, not a fan of Elon Musk. He was putting down Twitter. I've been coming to this conference for about 5 or 6 years now. Every year, we have somebody come on and basically say, Tesla stock is garbage. And we had Scott come and say the same thing. It's garbage. And it's amazing because Tesla stock, we know what it does every year. It keeps going higher. I'm one of the bulls, so I love when we see people out there bashing him. But what a great way to kick off the conference. We had a couple other names you may be familiar with. Brett Eversole, he works with Steve Sugarwood, one of our analysts here for many years. He was one of the more positive speakers out there. He put a goal by the end of what I call the roaring 2020s. He said by the end of 2030 that the Dow could hit 150,000. That's about a 5-bagger here or so. Yeah, I'll tell you what, I hope he's right. And I think there's a path there. But he made a great case and he shared 4 new stocks with the attendees here today. We had Meb Faber, who came on the podcast a couple months ago, still leaning a bit cautious. We had a good old friend of mine, Lakshman Achuthan, and again, leaning a bit cautious. He's not as much a stock guy, but he's more of an economist, looking at cycles, believes the recession really just starting. Probably won't end for about 3 to 4 quarters, if not more. That's looking a year out. But what he did say, stocks typically bottom about 4 to 5 months before that recession really bottoms out as well. So that's telling you we could have a great buying opportunity in the very near future. We had Austin Root come on stage. He is the CIO at Stansberry Asset Management. We just had him on the podcast last week. You know what he's all about. Jamie Roginski, a guy from Wall Street Bets, the meme stocks. Also, he's been on a show in the past. We know what he's about as well. Always a great speaker. Then we had a guy by the name of Hugh Hendry, who we're going to have coming on a show here in a couple of weeks. Quite the eclectic guy, not by just looks, but the way he speaks. Talked about the Fed, talked about the US dollar, talked about interest rates. Really, really great personality. Looked like a half, kind of between Johnny Depp and Bono up there, his outfit. And I'll tell you, he was at dinner last night too. The guy's a character. We're all drinking wine and he's pounding tequila. I mean, he was a great guy. But we're going to have him coming on a show here coming up as well. Also, a couple other guests we're going to be grabbing. So the next 4 weeks or so, we're going to be inundating you with great guests that we're capturing right here from the show right now that we have here as speakers. And Lakshman, who I just mentioned, we have him coming up in a few minutes from now because we sat down with him live today. You're going to get his view on when he thinks the recession is going to be coming, and more importantly, what that means for stocks. All that and more coming up right now with Lak. A good old friend of mine, we used to do TV back in the day together. He's here speaking. He's here sitting together again many, many years later. Lakshman Achuthan.
You got it.
I butchered that, folks. I really did. He's just being kind right now. But thank you so much. I mean, you work with a lot of cycles, right? Cycle research right now. And I follow you, obviously. And I know you're probably a different view than me, which I love my viewers to see because we don't want everybody to be, bullish like me, long term. So you still think there's more of a recession coming. Why don't you talk a little bit about that?
Sure, and I am bullish long term.
Good.
But I would say that from a cyclical perspective, we're in a growth rate cycle downturn. We're decelerating. I think most people are on board with that. They would agree with that. And that when we look at our forward-looking indicators, not the coincident data about like what's happening right now outside your window, look at that forward-looking data, it's weak enough, the trends there are pretty clear, that we do expect the growth to go negative, and for there to be what we call a recession. It's when the economy contracts a little bit. It makes sense. I mean, it's not the end of the world. Okay, this happens, especially when you have a big boom, and even more so when the Fed is joining in and trying to slow the economy down, and when there's a lot of weird kind of after effects of COVID and supply chains and stuff globally that is also moving us down. So there's kind of a global slowdown. All of that means, in our view, and looking cyclically, which is out a few quarters, it's not long term, that we're going to have a recession in front of us. And just to make it interesting, we had this inflation cycle upturn, even though we were slowing. And that makes it that's like another dimension. It's like three-dimensional chess.
We're kind of in unprecedented areas, right, when it comes to the Fed, because typically when you see, you don't see them raising rates as growth's coming down. They'd be kind of doing the opposite, try to help the economy. But obviously inflation's been such a pain that we've been working on that. So real quick on inflation, is there something you're looking for as a trigger? I look at 1/3 of the CPI is shelter, rents and homes. And you're starting to see at least the acceleration slow a bit there.
Yep.
So if we start seeing that come down in the next couple of months, do you think that will give the Fed the ability to at least slow down and maybe pause at some point early 2023 to help us from going into what could potentially be a deeper recession?
I think there's some possibility of that. When we look at the forward data, so there's the actual inflation, like the rents, the food, the energy, wage inflation. There's different types of inflation. You put it all into the basket, and that shot up. And I would agree with you. I think it probably has peaked. When we look at our forward data that leads the turning points in the inflation cycle, that's turned to the downside. So I do think when you add it all up, all these different pieces, the worst is actually behind us. The problem is it's just not coming down fast enough. It's sticky. Rents are sticky. Landlords are the last ones to say, "Oh, let me give you a break," right? and if you get an increase in wages, you're very reluctant to give that back. So these are sticky parts of inflation that probably don't recede fast enough for the Fed to do anything soon, I think, to change their mind. They're going to want to see things like job losses. And job losses are something that actually have to happen if there's going to be a recession. So now I'm going in a little roundabout way, right? So I'm saying they need to say job losses. You have to have job losses for a recession. Recessions, like a reasonable rule of thumb, is that recessions do kill inflation. They really, this is the demand destruction. And they will push inflation down. The Fed is saying, in a way, if I have to choose two bad things, right? One is recession, which I don't really want, but I really don't want inflation. I'm going to go for the recession. And I think they've taken that choice. I think they've made that decision.
Which I think has led to the stock market, continually to hit, or trade near multi-year lows because the Fed has been so hawkish and aggressive on that. Do you think that they could possibly, they being the Fed, overshoot because it is sticky? So maybe, what they're doing, these interest rate hikes are going to work, but it's taking a little bit longer than they think or that they expect, that eventually inflation does come down, rates are so high, which could lead to a more prolonged recession, in my opinion.
It could make it, well, let's say volatility is here, right?
Yeah.
We're already seeing it, and it's not about to like disappear and chill out. So we should be prepared for volatility. Will they overshoot? Probably. They usually do.
Yeah.
And here, it was a few years ago, it was actually just before COVID, they said, look, we're pretty bad at forecasting, so we're not even going to try. They said it in using many more words, but I'm just saying, they were like, we're giving up. And so they're just waiting to see what inflation does, which is in the rear view mirror.
Yep.
So almost by definition, they're saying we're going to overshoot.
Yeah.
And so I would be watching for that. And that's why volatility is almost sure.
So as an investor then, is there something you're looking at to say, okay, now's probably a good time, the recession's been priced in, let's say, to the stock market. Anything you're looking at that have the average investor start putting money in?
So I'm really good at cycles and turning points and growth and inflation. I am not an investment advisor. I can point to a relationship that historically has held pretty darn good. And anything that holds up historically, you want to at least know about. If there's a bottom in the recession, so let's say there's a recession happening in the next couple of quarters. Okay. If you see the bottom of the recession taking shape, then stocks as a leading indicator, an imperfect one, right? But they are a leading indicator. They typically bottom 3 to 5 months before the bottom of the recession. So in my mind, if I'm thinking about risk, I'm saying if I could see the bottom of the recession, now I can start talking about risk. Even this is like the blood industries. There's still Warren Buffett or whoever, Rothschild, one of these guys said it, is like you buy when there's blood in the streets. That's the time. The coincident data won't look so good. Jobs will be bad, earnings will be bad, these kind of things. But that is a time when taking some risk. The longer term, like you were saying when we started, can be really, really good time to get in.
And I think, we have 500 or so people here this week, and it's first day, and I've talked to quite a few people, and it's amazing. They come up to me because I tend to lean more bullish and opportunistic. And we have a lot of people, my colleagues, that are very negative, stock pickers negative. And they're confused. I feel like the average person's confused. And then you throw on top of it, are we in a recession? Are we not in a recession? The White House says no. Some economists say yes. And I mean, isn't there
well, first that makes a market.
Isn't there a set definition of what a recession is? Or have I been wrong for 25 years?
No. There's totally a definition. My mentor's mentor defined a recession. It's a pronounced, pervasive, and persistent decline in output. So you could think GDP or industrial production, income, real income. What are we earning? Less inflation. Sales.
Well, so far, those two tell me we're in a recession.
Those two do.
Okay.
Sales. Okay. Nominal sales, pretty good.
Yeah.
They knock the cover off. Yeah. But real sales, weak.
Yeah.
And then jobs. Are we adding jobs or not? And here on jobs, I think in particular, we've got growth. We're not in. It's hard to say we're in recession if you have jobs growth. There are some weird exceptions, and the weird exceptions occur during times when inflation has been high. Because nominal looks pretty good. Pepsi comes out, Delta comes out, we're killing it. Even United, and you're like, wait, even they're doing well. Yeah. And so you're like, okay, they're feeling pretty good. They've had a tough time hiring people, so they do not want to fire people, and they've got nominal jobs growth. In the mid 70s, the 73, 75 recession, it was a longer one, and it was more global. This is weird. Jobs growth didn't go negative until 8 months after the recession started.
Wow.
I mean, not normal.
Yeah.
That's just abnormal, but possible. And because the other pieces were coming down and some of the nominal numbers looked good. And so the C-suite or whatever was like, hey, wait a minute. I don't want to let them go because I'm making nice nominal kind of headline numbers. And then in 1980, right at the end of that recessionary decade, same kind of thing happened, but it lagged only by a couple of months.
Okay.
So it's possible that's happening here.
So do you think we could look back and say we are in a recession right now?
I think that's possible. Yeah. The recession may have begun. I can't say it has begun because I see positive jobs growth. But if we're a couple of quarters from now, it may be that it officially gets dated at the end of this year or maybe early next year. That's my kind of guess. End of this year, early next year, I think it becomes more apparent. That adds to your volatility I'm talking equities here.
Sure.
Bonds have been going crazy. We haven't talked about that yet, but equities here, it adds to your volatility because equities have been absorbing the rate hikes, right? So that's really been weighing on equities. I'm not sure. I think people are confused. How much of the earnings stuff has been priced into equities? We don't know. I mean, some companies do really well in recession.
I know.
There are ones that some Airbnb and these other things are. I mean, PayPal or different ones. These companies that I think even Gap, if you go back, these are all born in recessions.
Yeah.
So there's stuff there, but it's confusing.
It is a tough time for the average investor out there.
Absolutely.
It truly is right now. And you just brought up fixed income and bonds, and we're on pace to have one of the worst years in fixed income in last century. I mean, like literally, like horrible.
Horrible.
Obviously driven by the Fed pushing interest rates higher,
Yep.
Trying to fight inflation. Do you have a view on that? I know you don't do like the individual stuff, but what's your view on where that bond market and how that could lead us in or out of the recession at some point?
Well, I mean, the way it leads you out is they give it up. But they probably have to go too far
Before
first,
they give it up,
right?
yeah.
So we're not there yet. It has to become like so clear in their face that the recession is taking hold, and then they see some CPIs coming down, and then they'll give it up. We're not there today. And again, I mentioned how the Fed gave up forecasting before COVID several years ago. That actually, in my view, is why we're here.
Wow.
Because we all know that interest rates work and Fed policy work with long and variable lags. Okay, so it's not a perfect machine. It's a very difficult job. I am not taking away from the challenge. But it means you have to have some view looking forward.
Yeah.
If your control mechanism works with long and variable lags and you're looking out the rear view, it's not going to end well, and it hasn't.
Yeah.
And so now they're chasing this inflation, which they should have been a little more reactive to up front. And so here we are.
Yep.
I guess the last thing I would say is the rest of the world follows the Fed. So all these other central banks, right? If we jack up our rates, their currency gets weak, they've got to jack up the rates. Yeah. So now you have everybody around the world jacking up rates at a time when the world is slowing. So if your car is slowing and you need it to go faster, you don't hit the brakes.
Yeah.
That's what we're doing. So something there could go awry. That's the thing I don't know what it is.
Something has to give, right? I mean, it's like you just can't. That's not sustainable to keep doing that. I mean, something has to give.
So you saw in the UK, you saw some crazy stuff with the pound, right? I mean, big moves. You don't have a couple percentage points in a currency. That's not supposed to happen. And then we have to go to the yen, which is sitting there at 150 again, and they're burning money to kind of hold it there. They're trying to do their yield curve control where they keep long rates low. The Fed is saying, look, we care about the US, which they should. They're focused on the US.
Yep.
And as they jack up the front rates here, something could break.
Yeah.
I mean, or you should go to Tokyo on vacation. I mean, that's the other thing you could do.
I'm going to Portugal next week. I like the fact that euro's below $1 for the first time ever for me over there.
Well, I think these airlines are benefiting from this. Every
100%.
weekend is a holiday because, boy, if you go to Europe or you go to Asia, the dollar is king right here. You can get a lot with it.
I will tell you, I booked the flights, and I like to fly at least business when I go over there, just a long flight.
Sure.
They're expensive. I mean, really expensive. I mean, more than I've ever paid for a flight to go to Europe. I mean, it's amazing, these airlines.
Well, yeah. Basically, if you're a large company and you've got the product, okay, you don't have 100 choices to fly to Portugal. You got like 3 or 4, right? Yeah. So now you're a large product. We've got some brand loyalty. And you've got inflation that you could blame it on inflation. So inflation's running 8%, but they could jack up the price 25%.
Pricing power.
And you are going to pay it.
Yeah, it's pricing power. That's you would think that's the type of company that wouldn't do well in a recession because people would, tighten up the belt and not spend as much. But
Well, the
It sounds the
trick
opposite, right?
here's the trick thing, and this is where the C-suite gets tripped up, and maybe investors. Okay, is that works until it doesn't, right? Once the recession bites, all bets are off, and they're sitting with the capacity to Portugal. The dollar now is getting weaker, and they are not profitable. Yeah. So now their profits are going down. So this is the trick. It's kind of, you're playing musical chairs. Yep. How do you get your chair when the music stops?
You make me feel even more confused. Oh my goodness.
No.
I know. I'm not in a good way.
This is going to end. We'll survive. We've survived 47, 48 of these. Yeah. We'll survive this one.
So let me ask you this. Do you have a forecast as to when this may end? That's a tough question.
The thing that worries me is that we don't. The good thing is that we can't see that far ahead. Yeah. Okay. Yeah. So the good thing is we can only see a few quarters ahead. Yeah. So it could be 3 or 4 quarters out there that there's a bottom in there. That could very much be true, consistent with everything that I said. The bad news is that we don't see it sooner. Yeah. So we have a little more to go, and in the meantime, you have some pretty strong rallies. Yeah. And you say, "Am I missing out? Did I miss something?"
Or is it a dead cat bounce?
That's why you get paid the big bucks.
So let me ask you this: you talk to a lot of people in the industry. What is the view that you're getting? Do they believe we're near a bottom? Or what's the sense? Because you're a man on the street.
Yeah, a lot of I think so. So look, we're dealing with large institutions that are doing asset allocation globally, big ones, and then big C-suites, and look, it's a self-selected group. They like cycles that I'm working with. And they're managing cycle risk. They're prepared for this to go on for a few quarters. Okay. They're not embracing risk yet. They see the bear market rallies, right? So I don't know exactly how, in a big company, how you do that. Yep. They have ways of trying to do that, but your fundamental tilt is still more defensive at the moment. And the good news is, cyclically, at least the direction on inflation actually is to the downside. You just can't notice it yet. Yeah. I know. In your life, you can't notice it.
No, I do the grocery shopping for my house. I go and I see it. And I feel like if I go out, I went and had a martini the other night, and it was not a New York martini. It was a smaller town. It was like $20. I'm like, when did it go from 12 to 20? Did I miss that $8 increase at some point?
I see on FinTwit all the time. You see like the diner bill, And I took the kids out on a Saturday morning. Yeah. Everybody out like, pancakes this now. I'm like, whoa, that's like a night out.
It's like a night. I know, it's unbelievable. Now your night out is our pancakes in the morning.
Exactly.
Well, I always ask one question to my guests, and you don't have to answer, and it's different. You're not an equities guy, but if I send you and a family away for 10 years to an island, and one type of investment, and it could be just invest in America, it could be stocks, gold, whatever. Is there something that you feel comfortable with that in 10 years from now you believe will be much higher and a good place to put your money if you had to put it away for 10 years?
Well, look, I'm a sci-fi buff, so I'm going to lean towards tech. Okay. And various AI and tech kind of things. And so there are aspects of tech that are very cyclical, especially, and they can really get crunched in recessions. So if there's something that you've had your eye on and that you thought you missed the boat on, that's what you want to be looking for in the next few quarters as things bottom out. Because for your long-term bullishness, which I enjoy, I agree with, that's where you want to be. Because that seems to be, look, we've got big productivity problems structurally, and tech is part of that solution.
Yeah, I couldn't agree more. I mean, I'm an innovation guy, and I believe in innovation, but say like an NVIDIA or an AMD, which power a lot of AI and a lot of great innovation is going on right now, down 60, 70%, they're still cyclical. Yeah. But it doesn't mean that company's dead. No. I mean, there's a lot of great companies that are down 60 or 70%.
No, there's somebody smarter than me who said, hey, if it's down 60, it could go down, it could still fall 50%. I don't know. So I don't know the answer to that. So I'm just like, okay, I know cycles. If I like a long-term play like this, and I want to be part of that, and I didn't get it 10 years ago, 15 years ago, now you have a moment to get in and ride it.
The problem is, I tell us every time, I'll tell it on stage tomorrow, if I tell you a stock today that's hitting a high, and they'll say, Matt, if that pulls back 30%, I'm all over it. The moment it calls back 30%, I call them up. Oh, I'm not buying that thing. Are you kidding me? It's down 30%. Like
gotta have them write it down, put it on a sticky.
They feel comfortable buying at a high. It's tough for people to buy on a pullback.
well, it's tough to go against the crowd.
Yeah.
That is the tough thing.
Yep.
I mean, we feel more comfortable if others are doing the same thing with us.
I just gave a speech of that. I'm like, it's always tough to be the first guy in that restaurant, right?
Totally.
The restaurant across the street's packed.
Yeah.
It may be terrible and overpriced, but you feel more comfortable because everybody's already going
Exactly.
there. So, well, hey, listen, Locke, thank you so much for
My
joining us.
pleasure.
Looking forward to your speech tomorrow, and
Yep.
hopefully get back on soon.
Yep.
All right.
Thank
you.
Opinions expressed on this program are solely those of the contributor and do not necessarily reflect the opinions of Stansberry Research, its parent company, or affiliates.